And don't be shy, come on in. Welcome to Wealth Wednesday. My name is Jason Krausert. It's a nice fall day here in Calgary, and hope it is the same where you are. So today we're going to be talking about life insurance. It can be a very technical conversation, so I'm not going to get technical because I'm not a life insurance professional. I'm not licensed. I'm not a broker. I just did a little research and want to pass on some of what I found. So we're going to keep it kind of high level. But the main thing I wanted to talk about was just different ways of using life insurance. There's you can use life insurance. It's obviously certain uses when you pass. There's the benefits to that, but there's also ways to use life insurance while you're living to help fund a retirement or for other uses. So we're going to go over some of that. Just before I do that, I'm just going to share the broadcast with a few of my other groups, or a couple of them. If you can just bear with me for a moment, and then we'll just get that all handled and see if we can get a few more people on. One down, one to go. Whoops. Go away. There we go. And one more. Okay. Perfect. There we go. Thanks for your patience. Okay, so my name is Jason Krausert. I'm founder of More Life from Your Money, and as a debt counselor and a couples as a financial wellness coach, I've worked one-on-one with probably about 1,500 or so clients to help move them towards the peace of mind and freedom that comes from being debt-free and having a solid strategy for moving towards your financial goals. These days, I'm working mostly with couples moving towards retirement, 45 plus, and helping them develop a solid cash flow strategy so that they can be confident that they have the retirement that they want, debt-free, and then as well as having the savings and the finances in place that will help them to maintain the lifestyle that they want and that they've become used to. So again, today what we're going to be talking about is it's really an important topic. It's life insurance. It's an important part of anyone's financial picture of their financial plan. So it is an important consideration, but it is very technical. So again, whenever you're looking at different life insurance options, there's lots of information on the internet. But always talk to your professional as well, a certified life insurance professional that can go you through the different options, the different types of insurances, how much insurance is appropriate for you, whether you need insurance, that sort of thing. They can answer a lot of those questions, and it's a good idea to meet with a few people just to find someone that you're comfortable with and get a few opinions and see if you can have a few people come up with the same results for you, and then you're on the right path. So yeah, like I said, this is a really important part of your financial plan. Life insurance, like I said, it provides stability for your family after you go, but even during while you're living, it provides additional retirement savings, and so there's peace of mind there. It protects assets, and then make sure you can look after your family as well. So there's lots of great reasons for looking at life insurance. But there's a little bit technical. So I'm not going to get into a lot of detail, but I'm going to use a couple of terms over the next few minutes that I want to talk a little bit about now, so you have a bit of an idea of what I'm talking about, and that's the different types of insurances there are. So there's several different types of insurances. There's and there's subclasses within some of these different types of insurances. So I'm just going to talk again in broad terms about three of the most common types of insurances, and then these are things I'm going to be referring to a couple times over the next few minutes. So probably the most popular type of insurance, and not popular. Hi, Jody. Thanks, Donna. I would say popular perhaps in terms of most widely used is called a term life insurance. This is the most basic of insurance policies. That's basically a contract where you say with the insurance company that you will pay a premium every month for until a certain time, and if anything happens during that period, if you die during that period, then your beneficiaries will receive a lump sum payment from the policy. Simple as that. At the end of that period, you can either renew the policy or let it lapse. And if you let it lapse, it just basically lapse worthless. It's like renting life insurance. It's like kind of like renting an apartment. You rent, you pay your landlord a certain amount to get a certain benefit for a certain period. Then when you're done renting there, you just stop paying the rent and you leave, and you don't have any real benefit from that after that. You're just not renting that policy and you don't have the benefits of that anymore. So the same thing with the term life insurance policy. At the end of that period, if you let it lapse, you just don't get the coverage anymore, and you're not paying those premiums. Term life insurance is usually cheaper than the other types of insurance I'll talk about, and is generally less expensive. The premiums are lower the earlier in life that you get it, because it's based on, of course, your health and life expectancy and all that. So there's less risk for the insurance company if you take out a policy when you're younger. Therefore, your premiums tend to be lower. Okay, so that's term life. There's also whole life. Whole life is more complicated. It's designed as to cover you throughout your life. So rather than having ending at a certain period like term life, it's designed to cover you throughout your life. And so it also includes not only an insurance portion, but also an investment portion. So it's valid for the life of the insured. The insurance component will pay you a predetermined amount when the insured individual dies, and then the investment component builds an accumulated cash value that the insured individual can borrow against or withdraw before death. So that's one of the benefits, is you do have access to that cash value prior to death. It still has to be paid back into the policy. If it's not paid into the policy, then that amount that's still owing is just reduced from the benefits that are paid out at death. Then the third kind of general broad category of insurance is universal life. Now, universal life is a little more flexible than whole life. It does have both the insurance and the cash value component, like whole life. You can review and adjust the terms of the policy during the policy, and the premiums that or the interest that has been built up in the insurance or the investment portion and the cash value portion can be used to pay premiums if needed. So you have a little more flexibility with a universal life policy than a whole life. It's more affordable than whole life. Probably a little more expensive than term. It varies obviously with the benefits and the features. So those are kind of the three categories that we're talking about. So we're talking about so there's whole life, universal life, and term life. And I'm going to refer to these a couple of times in the next few minutes. Hi, Donna. Thanks for joining. Okay, so I'm just make sure I'm not losing my spot here. Okay, so, and again, like I said, term life is appropriate for individuals who, they just want a basic policy. They just want to make sure that you're going to be covered in the event that anything that you die. You may want to make sure that your family is covered. So it's just about making sure you have that coverage in place. A whole or universal policy is typically for higher income people that aren't too concerned about the higher premiums, because they can be quite substantially higher. And they may also be looking for a tax advantaged income in retirement. And we'll talk a little bit more about that in a few minutes. Okay, so I talked about the purpose of this webinar was 5 ways to use life insurance, some of which even while living. So I'm just going to go through those quickly now. Again, we're going to talk at a very high level. This is just to give you something to think about. Again, if you have any more specific questions about this sort of thing, talk to your life insurance professional. There's lots of information online, but it's best to talk to a professional who can give you the ins and outs, and you can take advantage of their experience, having worked with dozens or hundreds or however many clients. They can give you the benefit of that experience as well and apply it to your experience. Okay, so why use life insurance? Well, Obviously, the most common use would be to leave something behind for your family to make sure that your loss of income is covered, at least in part, by the life insurance policy, so that your family can, well, for different uses, they can pay debts, they can pay off a mortgage, they can maintain a lifestyle. It provides a level of security for your family that is left after you pass away. So that's one. Number two, and there's many more uses than these. I'm sure these are just a few that I found, and I did a quick, spent a few hours last night on the internet and got some information about different ways to use life insurance. And so these are a few of the ones that I found, but I'm sure there's a broad range of other uses as well. So number two, basically, it can protect your assets after death. Okay, so specifically what I'm talking about there is, let's say you have assets that you want to pass on to your family, whether that be properties or cash or investments or collectibles or whatever it is. You want to make sure that those assets get to your family. Now, how it works in most cases, that if you have debt, so let's say you have solely owned debts, or debts that are just in your name, after you die, those debts are paid out from your estate. So normally, those assets that you want to pass on to your family would have to first go to pay off the debt. So investments would be sold, the collectibles may have to be sold, all that to pay off the debt. What you can do with a life insurance policy is that now those debts can only be paid from the estate. Okay, so it doesn't become your spouse's responsibility to pay those debts unless they're a joint owner on the debt. It doesn't become a friend or family or anything. It's the responsibility is the estate's responsibility. Okay, so that the estate is what you have left over, your assets, your income and whatnot when you die. So what you can do is have a life insurance policy that has the estate as the beneficiary. So in other words, when you die, the beneficiary, or the money inside the policy, is paid into the estate. That money then can be used to pay off your debts rather than your assets. Your assets go to your family, assuming there's enough insurance to pay off the debts. And then the rest of so the assets go to your family, and the insurance is used to pay off the debts. So that's another way. That's a way to protect your assets using life insurance. Now, we talked a bit about, or I mentioned at the start, that there are ways to use life insurance while you're living. And so I'm going to talk about a few of those ways now. Basically, it's using insurance as savings. So one way of doing this is if you, let's say you get a whole life policy. We talked earlier about a whole life insurance. So let's say you get a whole life policy, and the premiums that you pay into the insurance builds up a cash value that you can withdraw during the term of or during the while you have the policy in effect. So depending on when you purchase this insurance, the cash value potentially, over the years could build up to be literally tens of thousands of dollars. So, let's say, if you buy the policy when you're 30 and you retire when you're 65, you could have tens of thousands of dollars inside the cash value of the policy that could be withdrawn or borrowed from the policy to supplement your retirement savings. Now, my understanding, I believe, is that can be withdrawn tax-free. So it's a tax-free source of income. Like I said, it does have to be repaid to the policy. If it's not repaid to the policy, then the death benefit is reduced by the amount that's owing. So it's may not be a big deal if that is the only purpose of the policy, is to provide that cash value and supplement your retirement income. As long as you have other insurance or whatnot to look after the needs of your family as well. So that's a way to have to supplement your retirement income with my understanding is tax-free income or the cash value inside the policy. Going a step further, so another way to use insurance as savings, this takes that what I just talked about a step further. So again, you have, I've heard it called an insured retirement plan. So basically, again, you have a whole life policy. You pay into the policy to build up to maintain the premium or maintain the insurance portion, as well as to build up the cash value. Okay, so you have the insurance portion and the investment portion; those build up. Now, what you do is that you use this policy as collateral for getting loans from the bank. The bank will then lend you money that you can use as tax-free retirement income. And then after your death, the idea is that the insurance or the insurance portion and the premiums will be used to pay off the loans. So that's kind of leveraging the insurance to get loans that will then be paid off with the insurance and the cash value. So there are, of course, risks here. If there's interest rate risks and whatnot, there's risks that can come into play that perhaps you can't. Let's say that the cash value doesn't grow as quickly as the interest, for instance, and so at the end of your policy, there's not enough cash value and premiums available to pay off the loan. That's a risk. So you have to plan that. I wouldn't. So again, I'm not recommending that you do this, but I would recommend that you talk to an insurance professional to see if that sort of a strategy is appropriate for you. I've got a link here that gives a little more information about that. It's from lifeinsurancecanada.com. I'll just post that in the comments section here, and then you can. Okay, so I'm just going to post that now, and again, that's the insured retirement plan. So I'm just going to put that in there, just if you want to get some more information. It's in there now. So the link is in the comments section if you want to get some more information on that, if you're curious about that. Then finally, number 5. This is a little bit controversial, I think, although I looked on some sites related to the Ontario government, and they're talking about this sort of a strategy as well. And I think about it, I feel a little bit funny about it, but I mean, it does make a lot of sense also. So I want to just put it out there, and then again, you can do whatever, you can do the research and then look into whether or not it's appropriate for your situation. But some people are saying, and what they're suggesting is that we could use life insurance for, and now again, this would be like a universal life insurance policy, is that you would take the policy out on the life of your parents, with yourself as the beneficiary. So let's say you do this when you're 30 years old. Okay, so you talk to your parents, you make everything, get it all set up, and you just explain what's going on. You take out a life insurance policy on the life of your parents. Maybe your parents are in their 50s or 60s. And the idea being that, hopefully your parents are going to live a long, fruitful life, but that when they do pass, you'll be closer to retirement. And then you'd be the beneficiary of the policy when they pass. So, I mean, again, there's some risks associated with that, as well as some benefits. Certainly, relying on that, if you're paying your monthly premiums into that life insurance policy, that's a contract, which means that when that policy is paid out, there's a certain guaranteed amount that's going to be paid out on the death, in this case, of your parents. So there's less risk involved in, say, putting that monthly premium into the investment markets, where you're going to have lots of ups and downs over a 30-year period, and you're going to be dealing with having to lose money and then rebuild it, lose and rebuild. With this sort of a policy, you don't have that sort of a risk. But what you do have is that you have less flexibility in terms of your payments. So it is a contract. So you are required to pay whatever the premium is per month to maintain that policy. If you can't maintain the policy, you lose the policy. Whereas with investments, something happens and you can't afford to save $300 a month, you just stop saving $300 a month. So there are benefits and pros and cons to that approach, of course. So again, I'm going to sound like a broken record, but talk to your insurance professional and do your research and see if it's appropriate for you. Get online, see how that sort of return, if you're paying in a certain amount per month for a certain period to expect a certain payout in 30 years. How does that compare in terms of a return on your investment compared to putting that $300 a month into an investment for 30 years at 8% average annual growth? And how does that all look? You have to do that math as well to make sure that it makes sense for you. So those again are just 5 ways that you can use life insurance. Some of them provide benefits to your survivor when you pass away. Some you can use today while you're not today necessarily, but during your life while you're living to supplement retirement income and that sort of thing, and get some tax benefits that way as well. So I think there's some information there worth researching and looking into. So I invite you to do that. There's a lot of the definitions that I got for this presentation came from Investopedia, so they have some good information there. So again, that's what I would suggest as my call to action or as your homework is just do some research. Think about what your goals are financially. Think about how life insurance might fit into those goals. Talk to an insurance professional and get a few opinions on that, and just see what'll work for you. If you have any questions at all, again, talk to an insurance professional about those sorts of things. If you have any comments or experience on anything that I've talked about, or anything to add or supplement what I've talked about, please leave a comment below. And I'd love to hear from you and share that information with the community. I'm here every Wednesday morning at 9 a.m. For Wealth Wednesday. The whole purpose of these talks are to share tips and advice and insights, and hopefully some inspiration to move you towards a healthy financial future and a healthy, vibrant, exciting retirement. Right above this video box is my link to my Facebook group, Rocket Retirement 101. Feel free to click that and ask to join the group, and I'll approve that. And then when I do, just make sure you click on the little notifications tab to make sure that you set up how you want to receive notifications of these and other posts that I put up in that group occasionally. I also have a Facebook page called More Life from Your Money, so you're welcome to join that as well and get some additional information there. That's where I talk mostly about the cash flow planning strategies that I'm doing right now, and also other topics of interest to people looking forward to retirement and looking for a way to have the retirement and secure the retirement that they want. So just want to acknowledge you just for taking a few minutes out of your morning to join me. I hope this was useful information. I hope that you got some value from it, and just the fact that you take the time to spend 15 or 20 minutes going through this sort of material really speaks to your own commitment to the quality of your own life and to your family. So thumbs up, way to go. As I always say, you don't need to see the whole journey in order to move forward. Sometimes we get stopped having to see the whole journey, so how things are going to go, how it's all going to roll out before we take action. So you don't need to do that. Just take the next step. Take the next step that you know to take, and the next steps will become clear after that. So hope you have a great week, and we'll see you next Wednesday. Okay, bye-bye.